The price of gold has been skyrocketing, recently hitting all-time highs.
UBS analysts forecasting prices could reach $2,600 an ounce by the end of the year.
So this begs the question, could gold be the asset of the decade? I'm going to do my best to answer that question for you and give you my prediction as to where the price of gold is headed and maybe how high it can go. I'm going to do that in 3 simple, fast steps. Step number 1, we have to look at this gold chart recently. Absolutely unbelievable. In fact, if you're a technician, this is about as good as it gets. We're going to use the GLD as a proxy for the price of gold going all the way back to 2020 to today's date. On the left, we go from $140 up to $240. So you'll notice at the beginning here, starting in 2020, after we went through that dip with the cerveza sickness, March of 2020, it pretty much went straight up with that nice uptrend, but then it started to go down all the way into 2023. But then it started to rise again, and more recently, it has gone parabolic to the point where it's reached all-time highs over $2,500. But it's not just the recent price that's impressive, it's the way this chart looks. And let me be clear, I'm by no means a technical analyst, but I do know some of the basics. And I know that when you have a consolidation pattern like this, and then, keys right here, that's why I wrote it, you have this big breakout, that usually is a very, very good sign, especially when you have even further consolidation and then once again, another breakout that we just saw recently. Whoa, time out. I want to be clear, there are no certainties, there are only probabilities, and when you're doing a proper analysis, you got to look at the technicals, but you also have to look at the fundamentals. And we'll be doing that later on in this video. But just when we stand back and look at this chart, the consolidation, the breakouts, you've got to come to the conclusion that the probabilities are very, very high that gold continues up over the next year. But I want to point out that nothing goes up in a straight line. It's always a roller coaster ride with a lot of volatility. And I expect the exact same thing with the price of gold. And there are some downside risks. And we're going to go over that right now. Step number 2. Now let's go ahead and look to see how gold responds in a recession. Most of you know the yield curve is inverted, and we're seeing a bull steepener, which would imply the odds are leaning towards a recession at some point in the near future. Again, there are no certainties, there are only probabilities. So what you have to do is you have to break down what you think will likely happen in the future, which scenario will play out. There's really 3 that I think we have to consider. Number 1, no landing. We don't have a recession at all. Number 2, soft landing, where we kind of have a garden variety recession, similar to what we saw at the end of the dot-com bust, but we don't have this big crisis liquidity event. Or number 3, we have a hard landing, and we do actually have that liquidity event, similar to what we saw during the GFC and what we saw for a short period of time during the cerveza sickness. So, editor, hopefully you've been putting these up maybe over here or maybe over there. That's probably the best place for them so the audience can see the different scenarios. And what we're going to do is we're going to look at a chart of the price of gold going all the way back to the 1970s, a log chart, but we're going to look at it through the lens of these 3 possibilities. All right, let's go over to macro trends. We can see that starting in, we'll say, September of 1980, the price of gold right around $674. Now, I don't know if this is a monthly chart or a weekly chart, but this is a good starting point regardless. Understand the concept. Gold pretty much goes straight down till we get to the end of the 1990s and really into the dot-com bust. But I want to pay very close attention to what it did during Black Monday in 1987. So that would have been October in 1987. And not too much. Not too much. It went up slightly, but we definitely didn't see a crash. Then we fast forward to the recession of the early 1990s. Doesn't do much there. Dot-com bust. Doesn't do much there. Starts the uptrend that took it all the way to, call it, $1,800 in 2011. But you'll notice the GFC was much, much different. Here, the price of gold got up to right around $968. But after Lehman blew up, the price of gold crashed. Why was this? Because gold was actually doing its job. Because, see, one of the benefits of gold is that it has no counterparty risk, and you always have a bid. It's always liquid. But when you have a liquidity event, you have a financial crisis. Well, all of these balance sheets that own gold have to sell something. They need liquidity. So if the only thing they can sell is gold, you should expect the price to plummet, which is exactly what we saw. And then we saw a small version of this during March of 2020, a more condensed version, because during the GFC, the price of gold went down from, let's say, March all the way to the end of 2008. But during the cerveza sickness, we saw that sharp spike down just briefly, maybe just for a week or two, before gold started to rebound and go back up. So why does this matter? Because if you think the odds are that we have a no landing, well, then based on the chart we looked at in step number 1, gold should continue to go higher, possibly without a hitch. Although, again, it never goes up in a straight line. Or if you think we're going to have a quote-unquote garden variety recession, like we saw in the beginning of the 1990s or after the dot-com bust, my base case would be the exact same for gold. But if we go to a hard landing, if that's what you think the most probable outcome is, where we do have a liquidity event, you've got to be very, very careful if you're just holding gold for price appreciation. Because if you're holding gold for an insurance policy, well, then it's a completely different analysis. But if you're really trying to get granular and get detailed and try to predict how these price swings are going to play out, then you have to acknowledge that there's a lot of downside risk with gold, possibly just like we saw during the GFC or during the cerveza sickness, if we have that hard landing liquidity event. But maybe you're someone that doesn't really care about the short term. You're more concerned about the long-term fundamentals. And that is what we're going to discuss next. Step number 3. Now let's go over the fundamentals and my prediction as to whether gold will be the asset of the decade. And possibly I might throw in a prediction as to how high I think the price may go over the next year. Okay, let's start by looking at a chart going all the way back to 1980 to today's date. On the left, now this is a very difficult chart to draw, just FYI. So editor, you're going to have to throw up the original chart quite often because this ain't so hot. But we start at $400, we go up to $2,600. This is a log chart, inflation adjusted for the price of gold, because we want to go through what most people think are the fundamental drivers of gold to see, well, how are these fundamental drivers going to play out in the near term and the long term moving forward. So if we go back to 1980, let's just take a look at the inflation adjusted price real quick. Goes straight down, as most of you know, and we discussed in the previous steps. And then in 2000, it goes up, flat lines, and then goes up to an all-time high to where it is today in nominal terms. Inflation adjusted, you see that although we might be at an all-time high, it's not by much. But if we go back to the 1980s, we see gold is pretty much flat, although it's been doing extremely well in nominal terms more recently. Now let's go through some of these fundamentals. First and foremost, interest rates. Well, everybody knows that when the Fed drops rates, that's good for the price of gold. wait a minute here. The Fed dropped rates from 1980 all the way to 2000. Interest rates, or at least a trend for interest rates, was down, but the price of gold was actually down quite substantially. Okay, so let's move on to the next one. Well, everybody knows that gold is a fantastic inflation hedge. Did we have deflation from 1980 to 2000? No. And did the rate of inflation increase or decrease from 2000 to, let's say, 2020? Well, many would argue that it decreased as far as the rate of inflation. Prices were still going up, don't get me wrong, but the rate at which they were going up was slowly declining. But during this time, we saw gold go down and we saw gold go up. So at very best, it's a coin toss when you look at inflation impacting the price of gold. I said on Twitter earlier that over centuries, gold is absolutely an inflation hedge. There's no disputing that. But over decades, maybe, maybe not, and over years, no. If you look at year by year, gold doesn't correlate with the rate of inflation. How about geopolitical? Well, we've had wars right here, and really no huge spike in the price of gold. Well, how about the dollar? Everyone knows that if the dollar goes down, that's good for gold. And if the dollar is going up, well, that's bad for gold. You kind of could have used that argument here in the mid-1980s. We had the Plaza Accord because the dollar value was extremely high relative to other currencies and gold was going down. And then starting right around the early 2000s, we did see the price of the dollar relative to other currencies start to go down and gold go up. But then right here, gold starts to go up while the dollar was going up as well. So from here to here, dollar going up and gold going up at the same time. So I don't really know that there's a strong inverse correlation between the dollar and gold. Well, government spending. Okay, well, we can throw that one right out the window because there was tons of government spending in here. Well, what about the Federal Reserve's balance sheet? Everybody knows that when they do quantitative easing, this is going to be good for gold. It's really going to drive the price higher. Not really, because the Fed did zero quantitative easing between 2000 and call it 2007, but yet the price of gold still went up and went up at a much higher rate than it did from, let's say, 2012 to today's date, when they were actually doing quantitative easing. So the punchline here is none of the fundamentals that people think or you hear drive the price of gold really do when you look at the hard data. But to a certain degree, it doesn't matter. Why? What I've learned in investing, especially over the last year, is if you want to make money, it doesn't matter what you think. It only matters what the market participants think. And if the market participants think this is what drives the price of gold, if you see changes to any of these that would lead the market participants to think that's a tailwind for the price of gold, well, effectively, it is at the end of the day. And when you look at Kamala Harris's new economic plan, you see that basically, if we were just to summarize it, it's price controls and free money. Okay, well, price controls and free money are definitely going to be a tailwind to inflation. So if the market perceives this to be a tailwind for gold, then that's going to likely benefit the price. But if we were to step back a moment and ask ourselves what really drives the price of gold, I think the only conclusion I can come to is counterparty risk and desire for liquidity. When liquidity is being prioritized, you're likely going to see gold go up. And liquidity is going to be prioritized more and more and more when counterparty risk increases. So during this time frame, we had counterparty risk, for the most part, declining. But once we got to the dot-com bust, then we go into the housing market, and then we zoom out and look at the monetary system becoming more and more fragile, and then it becoming crystal clear when we had the GFC. There's a strong argument that counterparty risk during this time was increasing. But when the Fed comes in and saves the day, according to the mainstream media, they do quantitative easing and all of these bailouts, then once the dust settles in 2008, then we see counterparty risk likely, or perceived counterparty risk, likely going down, less of a priority for liquidity. But then we start to see this reverse, especially when we get to the cerveza sickness, and you fast forward to today, when I think perceived counterparty risk is at an all-time high, and the desire for liquidity is only increasing. So then the question becomes, do I think risk and desire for liquidity will continue to go up throughout the rest of the 2020s? Easy answer, yes. So when you combine this analysis with what the market actually thinks moves the price of gold, you can see how there are some significant tailwinds, at least for the next year. So my price prediction for gold moving out 12 months, let's say we're at 2,500 right now, in nominal terms, I would not be surprised if the price of gold got up to $3,500 within the next 12 months. But keep in mind, it's going to be a volatile, rocky road. My base case is we do have a hard landing within the next year, which could bring down the price of gold quite significantly, but that's your buying opportunity, like we saw during 2008 and for a very short time frame during March of 2020. But now let's address the real big question. Do I think gold will be the asset of the decade? Another easy answer. Yes, I do. Do I think the price will go to 5,000, 10,000, 50,000? I have no idea. It could go back down to 1,000 for all I know. But even if it does, for me personally, it's still the asset of the decade. Why? Because I put a high priority on holding an asset that is liquid and has no counterparty risk. And gold has done that better than any asset for the last 5,000 years. And on that bombshell, I want to remind everyone, I have a free ultimate guide to buying gold. We'll go ahead and put a link in the description below. This is an extensive interview I do with my good friend Dana Samuelson, who's an OG in the gold business. We go over everything you need to know about buying physical gold, coins, bullion, how to store it, and most importantly, how to get a good price and not to get ripped off. Again, you can check that out at the link below, or you can just go to georgegammon.com/goldbug.